Imagine waking up every morning, going to work, spending hours in traffic, dealing with stress, and then watching a huge part of your paycheck disappear before it even reaches your bank account. Now imagine another person. This person makes millions, sometimes billions. They own companies, they own stocks, they own real estate. They fly private jets, they live in mansions. But somehow, legally, they often pay a lower tax rate than ordinary workers. Sounds impossible, right? How can a teacher, nurse, driver, office worker, or small business owner end up paying a bigger percentage of their income than some of the richest people on Earth? Is the system broken, or was it designed this way from the beginning? Today, we are going deep into one of the biggest financial secrets hiding in plain sight: the tax myth. The belief that rich people pay more simply because they make more. Because the truth is far more complicated. And once you understand how taxes really work, you may never see money the same way again. Welcome to Financial Education TV. And today, we uncover why rich people often pay less tax than you.
Section 1. The biggest tax lie people believe. Most people believe taxes are simple. You work, you earn money, the government takes a percentage. And the more you earn, the more you pay. That sounds fair. And technically, on paper, it is true. Most countries use what is called a progressive tax system, which means tax rates increase as income increases. For example, someone earning a low salary may pay 10%. Someone earning more may pay 20%. Someone earning much more may pay 30% or even higher. So naturally, people assume billionaires must be paying massive taxes. But here is the first thing you must understand. The wealthy do not make money the same way ordinary people do. And that changes everything. Most workers earn active income. That means money from labor. You exchange your time, your energy, and your skills for money. Salary, wages, hourly pay. And this type of income is usually taxed heavily. In many cases, before you even touch your money. Your employer removes taxes automatically. You never get the chance to protect it. But the wealthy? Many of them do not rely mainly on salaries. Instead, they earn passive income. Capital gains, dividends, rental income, business ownership, stocks, assets. And these types of income are often taxed differently. Sometimes much lower, sometimes delayed, sometimes almost avoided completely. That is the first secret. The tax system rewards ownership far more than labor. Workers get taxed first. Owners get taxed last. And that single difference creates one of the biggest wealth gaps in society. Section 2. How the poor and middle class pay taxes. Let us follow the journey of a normal worker. You wake up, you go to work, you earn your paycheck. But before the money reaches your account, taxes are removed. Income tax, Social Security, payroll taxes, health deductions, pension contributions. Then you spend your remaining money. And what happens? You pay more taxes. You buy food, sales tax. You buy fuel, fuel tax. You buy clothes, consumption tax. You own a car, registration tax. You own a house, property tax. You save money in a bank. Inflation quietly reduces its value. In many ways, ordinary people are taxed at every stage of life. You are taxed when you earn, taxed when you spend, taxed when you save, taxed when you invest. And because your income is visible and predictable, it is easy for governments to collect. Workers are the easiest people to tax. Their money leaves fingerprints everywhere. Meanwhile, the wealthy often structure their finances differently, and that structure changes the game.
Section 3.
The difference between income and wealth. One of the biggest misunderstandings in finance is confusing income with wealth. A doctor earning $200,000 a year may seem rich, but a billionaire whose company stock rises by $10 billion in 1 year may officially report very little income. That sounds crazy, but here is why. In many countries, wealth increases are not taxed until assets are sold. This is extremely important. Let us say you buy shares in a company for $1 million. 10 years later, those shares become worth $100 million. Did you become richer? Absolutely. But if you did not sell the shares, the gain may remain untaxed. On paper, your wealth exploded, but legally, it may not count as taxable income yet. Now, compare that to a worker. The moment a salary arrives, taxes apply immediately. This means the wealthy can become richer for years without triggering large tax bills. Their assets grow, their stock values rise, their businesses expand. But because they do not always sell those assets, taxation can be delayed, sometimes for decades. And delaying taxes is powerful because every dollar not paid in taxes remains invested, and invested money grows. This is why wealthy people focus heavily on assets. Assets create appreciation, and appreciation is often treated far more gently by tax systems than salaries.
Section 4. The secret power of capital gains. Now we arrive at one of the biggest reasons rich people often pay lower tax rates: capital gains. A capital gain happens when an asset increases in value. For example, you buy land for $50,000. Later, you sell it for $100,000. The profit is a capital gain. In many countries, capital gains are taxed at lower rates than ordinary income. Why? Governments argue that lower capital gains taxes encourage investment. The idea is that investors take risks, and if investments are rewarded, businesses grow, jobs are created, and economies expand. That is the theory. But in practice, this often benefits the wealthy most, because the wealthy own more assets: stocks, real estate, companies, private equity. So while workers pay high taxes on labor, wealthy investors may pay lower taxes on investment profits. Imagine two people earning $1 million. One earns it through salary, the other earns it through investments. The worker may lose a huge percentage to taxes immediately. The investor may pay a much lower rate. Same amount, different treatment. And this is where many people begin realizing the tax system is not simply about fairness. It is about incentives. The system rewards certain behaviors, especially ownership and investing.
Section 5. The borrowing trick of the ultra-rich. Now we enter a strategy many ordinary people never hear about. The wealthy often avoid selling assets altogether. Instead, they borrow against them. Let us explain. Suppose you own shares worth $1 billion. If you sell those shares, you may owe huge taxes. But what if you never sell? Instead, you go to a bank. You use your shares as collateral, and the bank gives you a massive loan. Now you have cash. You can buy houses, jets, cars, vacation properties. And loans are usually not considered taxable income. This means someone can live an extremely luxurious life without technically generating taxable income. This strategy became famous because many billionaires use versions of it. Their wealth keeps growing because they still own their assets. Meanwhile, they use borrowed money to fund their lifestyle. And because their assets continue increasing in value, repaying loans becomes easier. Think about how different this is from ordinary workers. A worker needs income to survive, and that income gets taxed. But wealthy individuals may use debt strategically to avoid selling, to delay taxes, and to maintain ownership. Debt for the poor often creates stress.
Debt for the rich often creates leverage.
Section 6. How businesses reduce taxes. Another major reason wealthy people pay lower taxes is business ownership. Businesses come with deductions, and deductions reduce taxable income. This is a huge advantage. Let us say a normal worker buys a laptop. They usually buy it using after-tax money. But a business owner may classify that laptop as a business expense, which reduces taxable profit. The same can happen with travel, vehicles, internet, phones, office space, meals, advertising, equipment. Some wealthy individuals legally structure parts of their lifestyle through businesses. This creates enormous tax flexibility. Now, not all deductions are abuse. Businesses genuinely need expenses to operate, but the system often gives business owners more ways to legally reduce taxes than employees. Employees have limited flexibility. Businesses have strategy. And when you combine businesses with accountants, tax attorneys, and financial advisors, wealthy individuals gain access to an entirely different financial world. A world built around minimizing taxes legally.
Section 7. Tax havens and offshore structures. Now let us talk about something controversial. Tax havens. Certain countries attract wealthy individuals and corporations by offering extremely low taxes, or sometimes no taxes at all. Places like the Cayman Islands, Monaco, Bermuda, and others have become famous for this. Companies sometimes register profits in low-tax countries, even if the business activity happened elsewhere. This is often done through complicated legal structures, intellectual property rights, licensing agreements, shell companies, international subsidiaries. To ordinary people, it sounds confusing. And honestly, sometimes that complexity is the point. Large corporations can afford armies of lawyers and accountants. Small workers cannot. Now, governments have tried to crack down on aggressive tax avoidance, but global finance moves incredibly fast, and multinational corporations are often several steps ahead. This creates a strange reality. A local worker may pay taxes automatically every month, while a giant corporation earning billions may spend years negotiating, restructuring, and minimizing taxes internationally. Again, much of this is legal, and that is what shocks people most. The biggest tax advantages often exist completely within the law.
Section 8. Why governments allow these strategies. At this point, many people ask an important question. If governments know rich people use these strategies, why allow them? The answer is complicated. Governments want economic growth. They want investment. They want businesses to expand. They want wealthy individuals to keep money inside the country. Because wealthy investors create jobs, fund companies, build industries. So governments compete. If taxes become too aggressive, investors may move money elsewhere. Companies may relocate. Capital may leave. And politicians fear economic slowdown. This creates a balancing act. Governments need tax revenue, but they also want investment. And because the wealthy control large amounts of capital, they often gain negotiation power. This is one reason tax policy becomes so political. Some people argue the wealthy should pay far more. Others argue higher taxes discourage innovation and entrepreneurship. And this debate has existed for decades, probably centuries.
Section 9. The difference between tax avoidance and tax evasion. Now we must clarify something important. There is a major difference between tax avoidance and tax evasion. Tax avoidance is illegal. That means hiding income, lying, fraud, refusing to report money. People can go to prison for tax avoidance. But tax avoidance is different. Tax avoidance means legally structuring finances to reduce taxes, using deductions, using loopholes, using legal strategies. And wealthy individuals often have professionals dedicated entirely to this purpose. That is why taxes are not only about how much money you make, they are also about how much knowledge you have.
and how much professional help you can afford. A billionaire may have entire teams managing taxes full-time. Meanwhile, ordinary workers often file taxes alone. This creates a huge information gap. And in finance, information is power. Section 10. Why the middle class often feels trapped. The middle class often experiences the heaviest pressure. Why? Because they earn too much to receive major support, but not enough to access elite financial strategies. They work hard, pay taxes, save money. Yet inflation rises, housing costs rise, healthcare rises, education rises, and many feel like they are running on a treadmill, always moving, but never truly getting ahead. Meanwhile, asset owners watch their wealth grow. Stocks rise, real estate rises, businesses expand. This creates frustration, because workers feel the system rewards ownership more than effort. And in many ways, financially, it does. Modern economies often reward capital more than labor. That does not mean hard work is useless, but it means understanding financial systems matters enormously.
Section 11. How inflation secretly helps the wealthy. Now let us talk about inflation. Most people hate inflation. Food becomes expensive, rent increases, fuel prices rise. Workers suffer because salaries often grow slowly. But inflation can actually benefit wealthy asset owners. Why? Because assets often rise with inflation. Real estate prices increase, stock values may rise, business revenues may increase, and debt becomes easier to repay with cheaper future money. This is another hidden advantage. Wealthy individuals often own assets. Ordinary workers often hold cash. And over time, inflation silently punishes savers while rewarding asset holders. This is why many wealthy people avoid holding large amounts of cash. They prefer investments because they understand one of the biggest secrets in finance. Money sitting still loses power. Assets tend to protect wealth better over time.
Section 12. The education gap. Schools teach many things, but most schools barely teach taxes, barely teach investing, barely teach wealth structures. Many people enter adulthood without understanding how money systems actually work. They know how to work for money, but not how money works. And that difference changes lives. The wealthy often pass financial knowledge through generations. Children grow up hearing conversations about investing, businesses, taxes, ownership. Meanwhile, many ordinary families only discuss survival, bills, rent, debt. This creates a cycle. Financial literacy becomes a hidden form of power. Because once you understand taxes, investments, and ownership, you start seeing opportunities differently.
Section 13. Why salaries alone rarely create extreme wealth. High salaries can create comfort, but long-term wealth usually comes from ownership. Owning businesses, owning stocks, owning real estate, owning intellectual property. Because ownership allows money to grow without constant labor. A salary depends on your time. Assets can grow while you sleep. And tax systems often favor that growth. This is why many wealthy people focus less on income and more on equity. They want ownership stakes, because ownership changes the tax game.
Section 14. The psychology of taxes. Taxes are not just financial. They are emotional. People become angry when they believe the system is unfair, especially when workers feel heavily burdened while billionaires appear protected. This creates distrust. Distrust in governments, distrust in corporations, distrust in financial systems. And throughout history, tax inequality has triggered protests, political movements, and revolutions. Because taxes affect everyone. They shape opportunity, they shape wealth distribution,
they shape society itself.
Section 15. Can ordinary people use some of these strategies? Now, here is the good news. You do not need to be a billionaire to learn from the wealthy. Many financial principles are accessible at smaller levels. For example, starting a small business, investing consistently, learning about legal deductions, owning appreciating assets, building multiple income streams, thinking long-term instead of only monthly. The goal is not avoiding taxes illegally. The goal is understanding how financial systems operate. Because once you understand the rules, you stop playing blindly. And financial literacy becomes one of the most valuable skills you can develop.
Section 16. Why the system may never fully change. Some people believe governments will eventually heavily tax the rich. Others believe the wealthy will always find new loopholes. The truth? Financial systems constantly evolve. When one loophole closes, another strategy appears. Because money is mobile, capital moves globally, and wealthy individuals often adapt faster than governments. That does not mean change is impossible, but it does mean taxes are deeply connected to politics, economics, and power rarely changes easily.
So what is the biggest lesson from all of this? The biggest lesson is this. The financial system rewards knowledge. It rewards ownership. It rewards strategy. Most people are taught how to earn money. Very few are taught how to protect it. And even fewer are taught how taxes influence wealth. The rich are not simply paying less because they are lucky. Many are using systems designed to encourage investment and ownership. Systems available mostly to people who understand them. And that is why financial education matters. Because without understanding the rules, people often spend their entire lives trapped inside systems they never fully see.
Final thoughts. So, do rich people really pay less tax than ordinary workers? Sometimes, yes, especially as a percentage of wealth growth. And now you understand why. Different income types, capital gains, asset appreciation, borrowing strategies, business deductions, offshore structures, tax laws favoring investment. The system is far more complex than most people realize. But complexity itself creates advantage, because people who understand financial systems can navigate them more effectively. That is why financial education is powerful. Not because it magically makes you rich overnight, but because it helps you stop making financial decisions in darkness. And once you understand how money really moves, how taxes really work, and how wealth is actually built, you begin seeing the world differently. Maybe the biggest tax myth was never about taxes at all. Maybe the real myth was believing everyone plays the same financial game. If you enjoyed this video, make sure you subscribe to Financial Education TV. Like the video, share it with someone who needs to hear this, and comment below. Do you think the tax system is fair, or was it designed to benefit those who already understand money? Thanks for watching.